at the end of the day, and I've said this before, anybody who's ever stayed in a hotel is an expert. And
Yeah.
we've all stayed in hotels,
Yep.
right? So that's how we approach our properties. What do we like? What do we not like? Talking about restaurants, I don't like eating in hotel restaurants, so make them not feel like that. I love the fitness side of it. Provide the best fitness experience gym in prime real estate that you can. Provide the amenities that you want. It's not rocket science. I had a mentor, guy called Jack Schaefer, who was one of the top hotel advisors back in the day. And he always reminded me, he said, Sean, don't complicate it. Real estate is a C student's business and hotel real estate is a D student's business. I represent that every day, by the way. And if you can't explain it on the back of an envelope, don't do it. And it's back to providing the product that the customers want. And we're all customers, so we know what we want and we know what we're looking for. So it's our job, it's our obligation to provide that in a cost-efficient manner to the properties and to work hand in hand with the brands to help them see what the next step is, where the market's going, what the customers are looking for going forward.
So you're already on the podcast once. So the fun thing is, like, the cat's already out of the bag. We can just kind of go into maybe some deeper stuff. We can go into some updates and maybe some things that don't directly correlate to business or hotels. Who knows where we'll go. But we were just talking about AI and ChatGPT, and we certainly didn't talk about that before, but you were telling me that everyone on your team is encouraged to use it. And I'm curious to know how you use it and what are some of the things that you're doing on it and how it's changed your business.
Well, Jake, thank you for having me back. I had a blast, I guess, over 2 years ago when we did this the last time, but thank you for having me back. It's interesting. Over the last year, chat has become one of my best friends, my therapist, my analyst, my consultant, my dietitian, my everything. It's amazing. And I've learned that as you train it, as it gets to know you, and I literally speak to it like a person, and I upload questions and all of that stuff. But I'm of the firm belief that if you don't have a personality and you don't have relationships going forward, AI is going to take a lot of jobs. So I'm encouraging my team all the time to use AI, chat, or whatever they want to use to make their work easier, to automate as much as they can of the grunt work or the menial type work, and have more time to think and use it to their power and develop their soft skills, their relationships, their network, all of those things that are important. Because at the end of the day, we're in a people business and people do business with people they like. So let's use AI to make us more efficient, to make us more knowledgeable, and continue to enhance our soft skills, which I think are critical going forward.
Have you thought about basically, we use Dropbox, for example, like almost taking your entire company server and uploading it to some sort of AI so that your team can communicate with the documents that they have. So if someone has a question on a loan, or if someone has a question on returns, they can quickly type it into the chatbot and get a response. Have you done any digging?
So I'm thinking about it a lot and actually talking to some consultants. Where we need to be careful is to protect the ecosystem. And the SEC is very focused on this, as they should be, as registered investment advisors, that our confidential or proprietary information isn't getting out there. So Microsoft actually, who owns, I think, 49% of OpenAI, they have a product called Copilot, which comes with your Microsoft 360 or 365 subscription. So we've had training sessions with that. But where I would love this to go is when I look at our asset management side of the business, which is really the backbone of what we do. These people do an incredible job turning our assets around on a daily basis. But let's use AI to be less reactive and more predictive. So we not only have our data, so if we can take away the manual uploading of P&Ls from all the different brands and managers into our asset management dashboard, but really use AI, and we've talked to some consultants about this, where in our asset management dashboard, we're pulling data from convention center stats, from airline seats, from credit card spend by zip code of people who visit our hotels, from earnings reports from public companies that are booking groups at our hotels. So we can become more predictive as to what's coming down the pike as opposed to reacting what happened in the rearview mirror last month and just reporting on the traffic. And so we're putting a lot of energy and work into that because this data is going to be powerful. And I will add that I could not be more excited about the business that you and I are in today, this hospitality as a real estate asset class, because when I look at how asset classes are changing, like office, people are working differently. So in general, it's an asset class that's changing. Retail, people are shopping differently. As an asset class, it's changing. Residential, people still need to live somewhere. And I think, and we might have talked about this on the last podcast, but something fundamentally changed in the human psyche during COVID, and this experiential travel is on the rise. So we're in the right space right now. How do we use AI and that data to become far more efficient, to be delivering great products, great performance in our assets to our investors and to our, the guests who are staying in the properties?
Do you think AI on a property level is going to be more behind the scenes and less front of house? Or do you see, robots cleaning rooms and people checking in with computers and not a front desk person? How do you think about that side of the AI?
I think you've really got to, again, we're only scratching the surface. So I couldn't begin to tell you where this is going to go. But it depends on which level of hotel you're talking about. I can absolutely see robots and all of that coming into more of the select service side of things. But as you get to the upper chain scales, people are staying there for the experience. And I always say people, when I get asked about Airbnb as a competitor to the types of hotels we own, it's well, people stay in our hotels for the full service offering.
Exactly.
And a lot of that is the interaction with other human beings on the service side. So I see it being more back of the house in the types of hotels we invest in, and I see it being all over in more select service properties where you're not staying there for the human interaction or for the amenities that are being offered.
You talked about an asset management dashboard, and you have this huge portfolio of a lot of hotels, but also a lot of big hotels with a lot of stuff going on. Hotel technology, I think, is like 10 years behind regular technology. So I'd love to learn more about what that dashboard looks like, how you created it. There's things that seem to be getting put in that dashboard that I'm not putting in my dashboard. So I'm really interested.
We have a terrific guy on our team, Matt DiCillo, who started off as an internal auditor, I think, with Marriott. And Matt is very technology forward. And so he's really helping to revamp our dashboard at Trinity. And we continue to evolve it so that it's providing the data at our fingertips that make us better being at being predictive and not reactive. And so at a glance, we can see exactly where the shortcomings were by asset, be it RevPAR, occupancy, performance stats, group pace, all of those things. And that enables us to work hand in glove with the brands, because most of our properties are brand managed, just given the size of them. But I view our job is to be forward-looking, because the managers on the ground, they are forced to be myopic. They're trying to run this huge operation on a day-to-day. And our partnership with them is really hand in glove, that we're sort of looking forward, making sure that we're not only anticipating trends, but we're also providing the product that they need that they can then go and sell. And, I think we've proved that with several of our assets that have come out of their renovation stage, and they're ramping really well because of the product that the customer wants, and then just making sure it's a very efficient operation.
We recently acquired the White Barn Inn in Kennebunkport.
Love that asset. Congratulations.
Thanks. It's exciting. And I don't know why we didn't start buying hotels that I really want to stay in or really want to go to earlier. I should have learned from you earlier on, because you were early to that trend. But one of the things that I would get asked from potential investors on that deal is, oh, isn't this very risky because, the restaurant's so famous, or the rates are so high, or the hotel is so small, it's only 30 rooms. And they were talking about that in the context of maybe a 200-room Marriott or something. And I said, actually, I think those hotels are a lot more risky today than something like this, because it's just leisure. It's super high end, which has proven to be more resilient over the past few years than any other class of traveler. And there's just so much more to do because you can pull so many leisures. Have you seen that and experienced that? Because you're very excited about what's coming, but there's other segments of the hospitality industry that potentially are obsolete or that are, due for a major reckoning.
Look, the White Barn Inn, there's only one White Barn Inn in the world, and it's got a following, it's got a reputation, and I couldn't be more excited with you as the steward of that asset going forward. But we've always tried to stay out of the commodity side of the business, because on the commodity side of the business, you're purely competing on price for the most part. And so that's why the assets we invest in, again, all high barrier to entry markets. They're not building these anymore. They're all in markets that, are more destination-oriented markets. And they're obviously larger because we're catering to group, leisure, corporate, all of that. And we can dial up and down between it. But we use the group as a good solid base. And then you fill in all the other amenities. And if you take our property in Orlando, it's a great example. So it's almost 1,600 rooms. It's a 1,000-room JW Marriott and a 600-room Ritz-Carlton, and a ton of meeting space. And there's so much going on there on a daily basis. But what's fun is we've not only completely redone all the food and beverage, so you don't feel like you're eating in a hotel restaurant. They feel like independent restaurants. We've built this big water park with slides and everything. There's a lazy river that was already there.
Wow.
And what's happening is families are staying there to go to Disney, and after a few hours, the kids are tapping their parents on the shoulder and saying, "We're tired of standing in lines. Let's go back to that hotel and go on the water slides," or whatever. So what we've learned, if you provide the amenities on site, that helps you capture further customer spend on site because you're giving them what they want, be it in the restaurants, cabanas, pools, all of that. So it's all back to that experiential travel. But with the White Barn Inn, they're not building that anymore. Nobody can replicate that. It's a unique asset, and I think it's poised for tremendous success under your stewardship.
Thanks. Yeah, there's actually surprisingly more upside than we underwrote and that I realized. And one of the things that was interesting to us is the difference between how maybe a bigger brand versus a brand like Auberge looks at kind of the CapEx and the renovation process. Yeah. And the bigger brands, maybe because they're so big, are more on these like just years.
Yeah.
But if you and I were like independent inn owners, we wouldn't look at the world like that. We would look at it, well, we need to renovate the lobby because it doesn't look right anymore.
Yeah.
Or we need to do this because it could be better. How have you seen it now owning like big brands, but also working with some of these smaller, very luxury brands?
At the end of the day, and I've said this before, anybody who's ever stayed in a hotel is an expert. And we've all stayed in hotels, right? So that's how we approach our properties. What do we like? What do we not like? Talking about restaurants, I don't like eating in hotel restaurants, so make them not feel like that. I love the fitness side of it. Provide the best fitness experience, gym in prime real estate that you can. Provide the amenities that you want. It's not rocket science. I had a mentor, guy called Jack Schaefer, who was one of the top hotel advisors back in the day, and he always reminded me, he said, "Sean, don't complicate it. Real estate is a C student's business, and hotel real estate is a D student's business." I represent that every day, by the way. And if you can't explain it on the back of an envelope, don't do it. And it's back to providing the product that the customers want. And we're all customers, so we know what we want and we know what we're looking for. So it's our job, it's our obligation to provide that in a cost-efficient manner to the properties and to work hand in hand with the brands to help them see what the next step is, where the market's going, what the customers are looking for going forward.
Are you bringing things that you're seeing in your smaller, more luxury properties to your larger 1,000-room properties and sharing back and forth?
Yeah, so part of it is, there's always a repositioning play because we are value-add investors. And that repositioning is through renovation and asset management. Sometimes it doesn't need to be renovated. And so as much time as we spend on the product and improving the top line and it's making sure you have the right ratio of total revenue per available room. It's not just RevPAR anymore. How do you capture as much revenue on property? And then we spend an inordinate amount of time on the middle part of the P&L because so much can be lost there. Are we challenging our insurance premiums on a daily basis, on a yearly basis? Are we challenging property taxes? Are we continually looking at expense ratios? So you too, we all have the benefit of seeing those across properties. We have data at our fingertips with Smith Travel and all of that. So those are disciplines we can bring across the portfolio, regardless of the size of the property. When we bought the East in Miami, we noticed that most of the business was coming through OTAs, online travel agents, and that's very high commission business. So how do you change that and go after direct corporate accounts and things like that, where you're eliminating that load? So we have to be on it every single day, and we have to also be on top of the organization, because organizations by nature just grow and get fat over time. We had the great opportunity during COVID, while it was devastating to have to close these hotels, we were able to really go back to, sort of zero-based budgeting and figure out what the optimal, staffing levels are and should be to make sure you're delivering the service, but you're not overstaffed unnecessarily. So we spend a lot of time thinking about that.
What are some of the total RevPAR initiatives that you've undertaken at individual hotels or kind of portfolio wide?
Well, we look at these larger properties that have a group base. You have to be tough and say, look, you can't book our meeting space without the rooms, and you can't book the meeting space in the rooms without your food and beverage spend, and you can't book those things without the activities, if there's golf available, all of that. So but again, you have to provide a quality in those amenities that they're happy to book it. I couldn't be more excited about what's happening at the Diplomat here in Hollywood, which is coming up at the end of its renovation. And we're seeing the group pace, starting. Hilton's doing an amazing job. It'll be converted to a Signia next year. And, just watching that group pace build, because meeting planners can now come and see the amenities. We've redone all the pools, the restaurants, creating a beach club, creating a Signia club lounge, and all of that. So that's what they're looking for. And with people working, it's not even working from home, people working from anywhere today, when companies want to bring their people together, they're not going to get them to go to Milwaukee. Nothing against Milwaukee for an offsite. They want to go to Florida, Texas, Arizona, Southern California. So that's why we keep focused on those markets.
It's amazing. So we talked a little bit about the Diplomat, but maybe you can talk more about it, because you bought it at a great time. It was under contract, I think, with someone else, but it kind of went through a renovation. How did you approach the renovation when you had it, and what was your vision, and how did you kind of get there? Was that mostly you, or do you work with a lot of other people?
I wish I could take credit. I have zero vision. When it comes to things like that. So,
you're just good at picking the assets?
No, we do it as a team approach. So, Trinity, there's 4 of us who are partners. So it's myself, Lee Nybart, who's our chairman, Greg Dickens, and Ryan Dunn. Now, Greg is very talented at, he can walk into any hotel and know what needs to be done. And Lee has been in the business for 50 plus years and has seen every trick and can help us foresee where the pitfalls are going to be. And then Ryan really ran the transaction for us, getting it financed and so forth. So we approached it in a very collaborative way. And then, the part of the secret sauce with Trinity is that we have close to 50 professionals now.
Wow.
And we handle everything in-house, from not only the acquisitions, but the asset management, project management for renovation work, reporting, all of that stuff. So as opposed to most firms where, and I shouldn't say this, but the old way of doing things was an acquisitions team would go and find an opportunity, underwrite it, close it, give it to the asset management team, and they'd be like, well, how are we going to meet these projections?
That's not the old way. I think a lot of people still do it that way.
So we've turned it on its head. Every acquisition, from starting with the underwriting, project management, asset management, acquisitions are all working hand in glove. So we end up with a pro forma that everybody signed off on. We end up with a budget for the renovation that everybody signed off on, but we don't do anything for the first year. In terms of the renovation, we spent the first year really planning and finalizing, getting the costs in line. And the opportunity that we saw at the Diplomat was, where are you going to be able to buy 10 acres of fee simple land on the Atlantic Ocean coupled with the 10 acres on the intracoastal. So we started with that. The meeting space, it's 200,000 net feet. That's to the side, right? So you can be checking into that hotel and not realize that there's a whole convention center that the hotel owns attached to it. The rooms were in great condition. Brookfield had done a great job renovating the rooms, but we really wanted to renovate the lobby so that it looked like Fallujah at one point. It was blown up and it's now all put back together. We redid the pools. Those are coming to an end. But the vision there was really, how do you provide an experience that if you're a group traveler, you've got everything you need. If you're a leisure traveler, you've got the beach, the pools, the gym, all of those things. If you're a corporate, you get in and out and do what you want to do. We have a great kosher kitchen, so we can cater to many groups. But that was the vision. How do we make this the preeminent property in South Florida at 1,000 rooms? Part of the collateral that we bought is there's a development parcel for 350 units in a condo tower, and then there's a 500 condo hotel tower as well. And so we sold those two parcels to Isaac Toledano from BH and to Related, and they're going to do that. So when they build the 500-room condo hotel, the Diplomat suddenly becomes a category killer, because with 1,500 rooms, they'll now be able to go after a whole different type of group business. And what I love about these hotels is that, I've used this expression before, you don't feel like the uninvited guest at a party. If you're checking in there for the weekend with your family, the group people you're not going to see people running around with badges on there in the convention center. And so it really caters to everybody. That's what we loved about the hotel. And it was our duty to sort of just bring it to the next level.
How do you strategize on the acquisition side, looking at hotels that are maybe 200 rooms versus these big 1,000-room hotels? Are you still pursuing both of them today, or are you primarily focusing on one of those?
So we've typically looked at 400 rooms and larger, and we've developed a reputation for doing big box hotels. We sort of fell backwards into that business and proved to be a good space to renovate them, etc. But we're also starting to look at the other end. It's like, how do we bookend our business? So I think in the right markets, picking up a high-end select service portfolio with the good brands like Hilton Garden Inn, Marriott Courtyard, those types of things, that is just spitting off cash flow, doesn't need heavy capex. I think for our investors, that would be a good diversification play to have that bookend. But no, in Europe, we opened an office right around the time you and I did the last podcast, and Ryan Don moved over there. So there we're looking at 100 rooms and larger. It's a different market. We bought the Park Hyatt in Zurich. We bought the Standard in London. Ryan just signed a contract last night to buy a hotel in Barcelona.
Oh, congrats.
So thank you. So it's a slightly different model. But at the end of the day, we're in this to make money. And so we should be looking at all opportunities and not just be tied to the big boxes, but looking at others as well in high barrier to entry markets. Over
the past 2 years since we last talked, what's been keeping you up at night on the challenge side?
On the challenge side, it's I am so focused on culture within Trinity. And because at the end of the day, that's what drives the business. It's having the right people at Trinity, making sure they're happy, making sure our investors are happy. I spend a lot of time in consultation with my partners trying to look around corners and see what's coming, and again, trying to be predictive and not reactive. But that's what it is. I used to worry a lot about politics, and I realize I can't control those things. But what I can do is just be a good champion for our team every day, making sure they're heard, making sure they have what they need, being a good partner to my partners, being a good steward of capital to our investors. I take that really seriously, not to lose money, to make sure that reports are timely, accuracy of information, and just to continue to build a culture of humility within Trinity. That's none of us are getting out of this alive, so we've really got to make a positive impact on people we spend a lot of time working with every day and our investors who are trusting us. So I carry that deeply, and that's not that it keeps me up at night, but if one of those things aren't going well, that's what keeps me up at night.
Your portfolio, I think, is probably better than the majority of the REITs out there, and the REIT stocks have just been getting crushed, and maybe a REIT hotel company is not the best way to own hotels. How are you thinking about your hold period, your capital strategy in the context of basically what we've gone through over the past 5 years, which is, I would say, a down cycle broadly with hospitality, although some hotels have been ripping. White Barn is an example. A lot of hotels in your portfolio are examples of those.
It's all about being in the right structure at the right moment in time. And, capital flows change. Somebody once told me that the capital never disappears. It just moves around, right? So we're not seeing right now the level of foreign investment in hotels in the US. Remember, at one point, some of the sovereign wealth funds were making a lot of direct investments. There were large Chinese companies and Korean entities making large investments. We're not seeing that right now, so we need to adapt. Something that I spend a lot of time thinking about is these properties that we buy, and you buy as well. We underwrite them for a 5-year hold. And what I've realized, especially with zero new supply in a lot of these markets, that if you continue to maintain them correctly, and if you continue to have the right ratio of asset managers to properties, like we have around one asset manager per 2 properties on average. And that's right, because these are big operations that we're watching every day. I would love to find the ideal longer term vehicle that some of these properties can be held in. And it's and the right mechanism that you can transfer them from an acquisition co into a longer term hold co. And unfortunately, the public REIT model is not that. Maybe it's a private REIT model. Maybe it's some sort of a continuation vehicle. But also making sure that if that does happen, that our investors that are in the fund that's more of the value add fund are, they're getting well taken care of. And maybe there's a separate vehicle where we're buying assets that are for a longer term hold. And I think they will continue to throw off high single digit to low single digit cash on cash returns with modest leverage if you continue to invest in them from a CapEx perspective. So I think that's going to be very exciting going forward. Like with the White Barn Inn, at some point you'll need to sell it, and it'll kill you to sell it because you'll never be able to buy that asset again. And so how do you marry those things in the right way?
Yeah, it's something, we would get that question, like, oh, what's the hold period? Like, what's your long-term strategy? Like, well, we always underwrite it to sell it, but you can never buy this again. So unless someone came around and offered us some crazy multiple where it was, insanely obvious, or we felt that we couldn't maximize any more value, I guess we would do it. But you really wonder if there's, you just can't time these hotel cycles. So it just has to happen. And 5 years is just an arbitrary number. So what I've been saying is you just have to be flexible. And when it's frothy and there's like a fervor to buy, then maybe you should be a seller.
Yeah. And the other thing is to always remember, and I remind myself of this all the time, we're in a business that you have to be analyzing your counterparty risk all the time, because not everything goes according to plan. And so we spend a lot of time thinking about who is our lender, who is our brand/operator, and who is our joint venture partner. Because when things do get difficult, you want to be in the trenches with people that you can have conversations with and you can work with. And that's, you take COVID, right? We had bought Grand Lakes in 2018. We'd bought the JW Marriott Desert Ridge in 2019. We bought the Westin Maui in 2017, and we owned the Hilton Cabo. Now, we had terrific counterparties in each of those. So we sold Desert Ridge earlier this year to Ryman. Elliott was our joint venture partner in that, but we ended up owning that for 6 years. We've been in the Westin Maui now going on 8 years with Oaktree, but we had the fires in Lahaina along the way. But we're in the trenches with terrific partners at Oaktree and Marriott, operating it as a Westin. And so sometimes things do take longer, but if you have the right counterparties, you'll figure it out and still generate the returns that you expected to.
Yeah.
Desert Ridge still ended up being over a 2x equity multiple for our investors. So that's that's a really important component, because as you do have to change course, having people with you that are shoulder to shoulder working with you through these things.
The other thing I'm thinking about is, while one-of-a-kind assets are hard to acquire, you can, if you really want to, probably acquire a one-off, one-of-a-kind asset at some point throughout a given year. But I think what's almost impossible to do is acquire a one-off portfolio of assets. So in listening to like your kind of thought process, it's almost like you have your value add people that are owning these one-off assets, and then maybe they sell it to like a continuation fund, which is a different group of investors, but they own the portfolio of all these assets that you can never replace.
Yeah.
I mean, LVMH is going to buy it from you one day. That's really like what happens, because, you had Belmond, you had Amman. Like, think of another collection of hotels. When you get to a scale, it's just almost impossible to find.
Yeah, it's interesting. So you look at the brands that have really done well over the luxury brands over the last few years. I really admire what they've done with Auberge. I mean, the growth that they've gone through and the assets they've added to their portfolio, they've done a terrific job. The same with Rosewood.
Yep.
Sonia Cheng's done an incredible job of putting that flag in the right markets and delivering the service standards and so forth. Amman as well. I mean, the growth that they've gone through. And so, but you've really got to have, like, the brands really need to have the capital behind them to continue to grow. And then Hilton, Marriott, Hyatt, who we just flat out adore. They've been incredible partners. They're growing in all the right ways. So it feels positive. And I think the business seems to be going in the right direction despite everything we've gone through. So it's truly an exciting time.
It's exciting. Are you more excited about Europe stuff or US stuff? Or are you excited about it all?
I'm excited by it all. I would love to get back to Japan at some point. We're focused on getting Europe built out in the US. But I'm very excited. But what's important with Europe is we didn't want to distract our team in the US with what's going on in Europe, because myself included, we all get distracted by the shiny object, right?
Of course.
So Ryan's in London. I'm going to run over and help Ryan. No, I've got a business to run here.
Yeah.
And so Ryan now has the core team in place, obviously on the controller side, asset management, project management, acquisitions. It's all in place. They're doing well. Of course, we're all there to support each other, but it wouldn't be right for me to be going to Europe all the time. Ryan's got it covered. He's doing a far better job than I'll ever do. My job is to be here, to be focused on what we're doing and where else we need to be going.
Do the European P&Ls look similar to US P&Ls?
The challenge in Europe is it's literally like here, as we move from state to state, there you're moving from country to country. So it's a whole different tax regime. Fortunately, it's mostly the same currency, so that's easy, but there's a lot of structuring that goes on. And so transactions tend to take a bit longer, but it's exciting. And there seems to be more competition in Europe right now, so it's really leaning on our relationships to make sure we get access to the right acquisition opportunities. Financing is easily available. I mean, here in the US, financing is easily available. There's so much credit capital sloshing around. And I think, buyers and sellers are starting to now converge around, the appropriate cap rates, and we're seeing some improvement in the bid-ask spreads and so forth.
You sold a hotel this year, the East Hotel, that I put in this category where the price per key is so high, but potentially actually you probably sold it maybe for less than replacement cost or right around there. But the NOI was there to justify it. There's another hotel, the Ben in Palm Beach, that I think has a similar conundrum where it had this huge NOI. The price per key got high. Maybe it limited the buyer pool. But then there's a whole bunch of other hotels that are kind of in the opposite side, where the price per key is like well below replacement cost, but the NOI isn't there. So there's this huge kind of disconnect. What are you seeing in the buy and the sell markets? And how did you get conviction to exit the East? Well, it was a home run, but.
Yeah. So one of the underwriting disciplines we try and keep is keeping cap rate parity going in and going out. And the improvement is what we do to cash
You mean
flow.
You don't buy it at an 8 and sell it at a 6?
I'd love to, but so that's a discipline we've always held. Look, sometimes
Smart.
you're buying things at a 0% cap rate.
Yeah.
I love it. My friend Shai Zellering said to me, he said, I'm either buying 0 cap rates or 9 cap rates. And that's really the truth, right? Because the 0 is you're betting on all the upside that you're going to bring. But no, like with the East, we've essentially sold it at the same cap rate we bought it at. But we were able to work with Swire to improve the cash flow. But that was a really important lesson for me, was that even keeping cap rate parity, we were able to deliver terrific returns to our investors. And sure, I was looking at the beach and like, well, they're getting like tighter cap rates than this. But look, we did well. Blackstone's going to do well. They were a spectacular counterparty. They always do exactly what they say they're going to do. When Scott Rabilko called me and said, I want to buy it, this is what I can pay, I can't pay anymore, I knew that he would be hard in 30 days, and I knew that he would close 30 days later. And that's the benefit of a counterparty like that. They were just spectacular to work with. But I learned that lesson, and it proved out what we've been saying to our investors about cap rate discipline on going in and going out. And that puts the onus back on us. We're not just riding the market. Our job is to go in there and turn the operation around, improve the operation. The East didn't need a renovation, but it was all just operational asset management. And I would love to do more business with Swire. Their corporate team, their management team at the East were just spectacular to work with.
How did you do that successfully? You bought it with Swire management. They managed it the whole period, and now I think Blackstone's going to have them. How did you kind of implement that change in the context of they were doing what they were doing? They probably were doing a great job, and then you kind of put rocket fuel on it. What did you do?
Well, we took the approach that if we believe we're good asset managers, we should be able to asset manage any brand or management company. And there was a lot of thought with the East about, not from us, but other bidders when we were buying it, about converting it to one of the US soft brands.
Yeah.
And we knew that Swire, they'd built it, and East is an important brand to them. So they weren't really thinking about being terminated or any of that. But what we've done at Trinity is our close to 50 people, they all live, breathe, sleep hospitality. So when we go into an asset management meeting, it's not an analyst that's covering 5 different real estate asset classes, and this is just another one of them asking questions about P&L variances. All of our people have worked in hotels, myself included. We've lived and breathed it. We come from a position of credibility, I think, and coming from a position of humility, meaning we know how hard it is to work in these hotels. So it's a different dynamic, and there's just a deep respect that we have for what the managers and the line employees and everybody are doing on a daily basis. And it's not going in and barking orders. It's like, how do we make this operation better, more efficient, more profitable? It's going to benefit you. It's going to benefit us. And as a result of the way we were able to work with Swire and with the East team, I'd love to do more with them. We were looking at an asset in New York last year that we were strongly considering making it an East.
Wow.
And so those are the relationships that we value, where we're not looking to do a deal and move on. If you look at everything we do, it's repeated with our joint venture partners, with our lenders, with the hotel brands and the operators. And it's back to a people business, people doing business with people they like.
Whether it's Blackstone or someone else, what are some of the things you've learned recently or found a new appreciation for in the negotiation side of a buy or a sell?
Just doing what you say you're going to do. You're dealing with the right counterparty if you never have to, and again, across all the counterparties I talked about, if you never have to pick up the document again. You, of course, have to negotiate it and put all those bells and whistles in, but you've got the right counterparty if during that hold period or whatever it is, you're never looking at the document again, because that just means that everything's working well, or that if you've had difficulties, you talk through them. And I'd say that with all of our counterparties, joint venture partners, lenders, and the hotel brands and operators.
What's been some of the biggest changes you've seen more recently on the deal side of the business?
And it's frustrating to me being on the equity side, right? But there's been such a rush of capital to private credit.
A rush. A lot of our friends have these massive funds and they're raising them in 6 months.
Yeah, they're like, oh, we've got preferred equity for you. And I don't want preferred equity. We want common equity. So that's been a big change, but it's a pendulum, right? It goes back and forth. And, it'll be interesting as interest rates continue to contract, what that does with private credit. It's way above my pay grade. I don't play in that space, but that'll be interesting to watch. But it is harder to find the right capital for hospitality on the equity space, because for a lot of people they're raising less equity than they had. I think I read a stat a few weeks ago that I think in the last 12 months only 20% of equity was raised for real estate funds compared to like 3 years ago, and that's almost directly correlated to the rise in interest rates. So now that we're sort of coming down, hopefully that changes. But it's such a unique opportunity, right? There's so many great acquisition opportunities. I would just wish I had a Hoover and I could go around and scoop up as much of it as we could.
So is equity your limiting factor right now?
No, I wouldn't say it's a limiting factor, because we're set up as a GP fund, right?
Yeah.
So we're raising our next fund, which is going well. And it's a different model in our GP fund. But then, working with joint venture partners, and we're doing that. We're bidding a property in Orlando right now with a long-term joint venture partner. We're looking at a select service portfolio. We're looking at a off-market portfolio as well. So we're finding the product. Unfortunately, we've been at this long enough that we know who has capital, who doesn't, who's interested in hospitality right now.
Did you think about just raising a fully discretionary non-GP fund before you started raising this second or third GP fund? Was that at all a consideration? So then you didn't have to go kind of syndicate or raise deal by deal?
Well, this is where Lee Nybart's sage advice came in. And, raising a first-time fund is very difficult.
Very difficult.
And Lee had a relationship with Citi Private Bank, who anchored us. And we came up with this GP fund concept, and where we don't charge a promote at the fund level. We earn our promotes from the joint venture partners. And that's how we raised the fund. And what we found, so when we raised Fund 1, we had 20 professionals. Now we're close to 50. And we found that we have a real niche where our joint venture partners, the large institutions or private equity firms, don't need to build the hospitality real estate sector expertise in-house. They can partner with us. And we're putting in meaningful equity through our fund, 20 to 30% of the equity, and partnering with them. And so it's a niche that we found. And, we earn our promotes on a deal-by-deal basis, which is also good. And we share a piece of those promotes with our GP fund investors, so they truly are on our side of the table. And it's a model that's worked well. So we don't have any plans in the near future to raise a true commingled fund like that. I think we found a really good niche where we can continue to partner with these large institutions who we value and they value our sector-specific expertise.
How do you think of the size? Because we're in the middle of our GP2 fundraise right now. And part of me is like, do I want to keep spending time raising the fund, or like a deal comes up, now I'm focusing on the deal, we're focusing on capitalizing the deal. Do I have enough money to do what I want? And then we can maybe go raise a third GP fund. How did you think about the sizing of yours? Because you raise GP funds that are larger than a lot of people's regular funds.
Yeah, and that's it's also because the single assets tend to be larger as well, right? But look, I don't think there's any magic number in terms of what you need to raise. What's more important is that you're deploying, that you're generating DPI for your investors. And so if it ends up being a smaller fund, that's fine, deploy it and then go and raise the next one. There's always ebbs and flows. So, we're focused on a very good pipeline. We're going to deploy. We're still raising for the next few months. And then we'll close this fund out and deploy it and then start raising the next one. And that's the way. You just got to keep moving, right? And doing good deals and be very focused on your track record and very focused on the DPI, because that's what the investors really care about. It's like that's the true test of if they're making money by investing in our vehicles.
Are you guys mostly participating in marketed processes, or are you trying to source off-market deals through your relationships and cold calling?
It's both. I'd say on the marketed processes, we're trying to take a step back, and as opposed to a marketed deal coming across our desk and saying, "Oh, that's a great opportunity," how do we take a step back and say, "These are the markets we like"? Again, it's being predictive, not reactive. These are the markets we like. These are the assets we like. These are the owners. By the way, when I talk to my friend Chat, he or she tells me every day everything I ask. And then how do we be proactive going after those opportunities? Or how do we work with the brokerage community to say, these are the assets we want? How do we go about and get them? And, 'cause investors always like off-market opportunities, but, at the same time, a lot of sellers need to run a process to make sure that they're being good fiduciaries and they're seeing the best pricing. And that's where the brokers come in. So we love working with Eastdil, JLL, Colliers, CBRE, all of them. They've been terrific partners of ours over the years. Sometimes they're off market, sometimes it's through them. It's all of the above. But we need to continue to focus on where do we want to be, as opposed to being told where we should be.
So we did White Barn as a syndication with a bunch of high net worth investors and family offices. And, for a little bit, we toyed with doing it with maybe a single family office or an institutional investor that wanted to have exposure to that and maybe some other things in our pipeline. And ultimately, if you have a lot of investors, you have more say, more control. And it's good and bad because we have partners in other deals that add tremendous value.
Yeah.
As you've been in this game a long time, how do you figure out what partner to pick, what partner to do business with, what partner that's going to add value and not add pain and stress?
That's a really good question. I think it comes back to doing business repeatedly with the same partners. And we're always looking for new partners as well. But making sure that your philosophies are aligned, right? And look, there are some partners that ebb and flow in and out of hospitality, and that's fine too. But if we've been good stewards to them and good partners and asset managers, when they come around again, we'll be there. There was a moment in time when we were rebuilding Trinity. We'd bought the Western Maui with Oaktree, who've been a terrific long-term partner of ours. And they weren't really looking to deploy into hospitality, but they helped us create the precursor to our GP fund. We created a GP partnership with Oaktree, where they put up capital, we put up, they put up 90%, we put up 10% in the expertise, and really used that as a GP vehicle to sort of build our track record that got us to the next level. So even though Oaktree wasn't looking to buy hotels, they loved the return profile being on the GP side with us in that sort of 2017 to 2019 period. And now we're doing deals with them again. We bought the Park Hyatt in Zurich with them. We bought the Standard in London with them. We're looking at other things in the US. So it does ebb and flow, but, just sort of keeping those communication lines open. And that's what we try and focus on.
Can you talk about the Standard in London deal a little bit?
It was that was a really interesting opportunity. So we have a great relationship with Hyatt. We bought the Park Hyatt in Zurich from them, and we were looking at the Standard, and it's a great location. It's right at King's Cross, and that's sort of the tech core of London, right? And we were looking at it as a lot of others were, but when we heard that Hyatt was buying the Standard brand, that was really a game changer for us, because at the end of the day, people traveling for corporate, they stay places where they can earn points in general, and then they use those points for leisure when they travel. And with Standard going into Hyatt, people being able to earn, Hyatt points, we thought that was a great opportunity. And then also to be able to buy fee simple in the heart of London with a brand, Standard, and the overarching brand Hyatt, who we believe in, it came together really well.
What was the deal like? What were the sellers? What was the opportunity?
So it was a marketed process. The sellers were they've become good friends of ours. They also own the One Hotel in London. Terrific guys, and the financing was that was a seamless process, and but for us, we really lent in when we knew that Hyatt was buying the brand, because that to us was the game changer.
What, other than points, what did you think they were going to bring?
But also, bringing sort of just the larger infrastructure behind them in terms of the day-to-day like our team knows how to work with Hyatt. We own obviously Zurich, we own the Hyatt in Greenwich, we own the Hyatt Regency Indian Wells, and so we know how to work with it, and we know how their systems are. And so there was just a great degree of comfort between us, and Hyatt confidentially helped us on the financing. They were in the meds with us to get it done. But it's that kind of collaboration that really helps these transactions happen.
You've got 50 people now. How are you kind of keeping this entrepreneurial vibe, entrepreneurial culture? You have a couple offices around the country. How did you make that work from 20 to 50? What changed? I want to talk about like how you meet and like the whole setup, because that's a pretty big jump.
It is. And, it sort of happens gradually, but one day you wake up and you look back and you're like, wow, we're more than double the size. But it's, look, having the company having started in Hawaii, Hawaii has an amazing culture of humility. And I'd mentioned that before. One of the things I loved there were many things. One of the things I loved about raising my kids in Hawaii was that everybody's under the radar. There's no flash. Nobody's driving fancy cars for the most part. It's just everybody's low key, and that's the way it is. And that's the most important trait that we try and keep within Trinity, is that sort of humility. And the other part of it is, I believe my job and my partners feel the same way. Our jobs are to be available all the time. And I think I said this on the last podcast, good news is nice, but we need to know the bad news really fast, and that way we're able to react to it and also create a forum that people feel comfortable sharing the bad news when it's there. The other thing that we've done is that we realized a couple of years ago that we would have these weekly IC calls that were really only the deal people. And I took a page out of Blackstone's Mondays at Blackstone book, where the whole firm dials in. And some people not within Trinity said, you sure you want to do that? You're discussing confidential information. And we were like, well, there has to be a trust within the firm. And we do have a high level of trust across all the disciplines. But we're now spread between Honolulu, LA, Miami, and London. And for us to all get on the phone at 1:00 Eastern every Monday, it's a sacred time. We don't move the time. If you can make it, you make it. If you can't, you can't. I personally do not travel on Mondays anymore. And we have this call. But again, it's growing pains, right? So then we realized that the call was just the four partners talking and some of the deal people, and it wasn't what we wanted, right? So we changed the format. We want to hear from everybody. We want anybody to feel comfortable asking a question. So now we not only we start off with a market overview, like what's happening out there, geopolitical, hospitality market.
Who gives that?
So I start with that. And then we go into like the pipeline and we discuss in depth, and look, and there's arguments that go on, like and it's great for everybody to hear. And then we go department by department, like what's happening in asset management / strategic operations, what's happening in project management, where are the challenges, what's happening in IR, like what's coming up there, what's happening in accounting, how was the audit season, did everything go in on time? And this way, it's a forum that everybody knows what's going on. And sometimes these calls last 90 minutes. Sometimes they last 50 minutes. But I so look forward to those calls, because not only I get to see everybody's faces on the screen, but it makes us feel so connected.
Yep.
And it's really, it's evolving, where it's a forum that people feel comfortable talking in. And there's 1,000% trust amongst us. And we're in it together, and it just feels really, really good.
Are you also having then weekly IC meetings and asset management meetings, or it's now all combined to the Monday?
So we still have what we call pre-IC meetings on a Thursday, where we get into the pipeline and sort of like that could be an hour and a half long. We're getting into that, and then asset management, strategic ops, they have their own weekly calls, and the same with project management. Because that's really where the magic happens, right?
Yeah.
Like what they do on the project management and asset management side, again, I wish I had that kind of vision. I mean, they are so creative and so just skilled at turning these properties around.
Can you talk about some of your biggest mistakes on that side, and then a couple of your biggest wins as well?
On the
asset management and project management side.
Look, we've got having grown up in Botswana in Africa, my kids tease me that I use animal analogies all the time. And one of them, I kept getting emails about the East, and I'm like, yeah, well, every once in a while, a blind squirrel can find an acorn.
Right.
So there's a lot of luck in this stuff too. And then look, we bought the W Hollywood in LA, and it's been a very challenging asset. And not for anything that we could have foreseen, in my opinion. We bought it right from Host. I keep asking Jim Rizzolo if he wants to buy it back. He hasn't returned my call. We partnered well with Marriott. They put up significant key money to show their commitment to W as a brand. We've taken it through a phenomenal renovation. I mean, it is truly a great product now. But we didn't foresee the screenwriter strike, and we're right in the heart of Netflix country. We didn't foresee the hotel union strike, and then we didn't foresee the fires. So it's been challenging. And when I think about what we could have done better, I'll tell you what we did right. We have the right counterparties. Marriott's been terrific to work with. Oaktree is our joint venture partner. They've been with us shoulder to shoulder through this. Our lenders, Acor and Kennedy Wilson, spectacular. It's just tough on all of us, but it just keeps reinforcing being in business with the right people, because there are challenges, and so I learn a lot from that every day. Just don't veer off course. Stay. We came out of COVID well because we were so disciplined about the markets we were in and the asset types we were in. We didn't foresee the surge in travel, but we didn't foresee COVID either. But we were in the right assets with the right partners that we could withstand it. So that's just become sort of such a core discipline to us today, is this counterparty analysis.
And I think it's time. Like, we have some assets that are similar to the W, where it's like, how has all this happened? You're kind of reciting it to maybe an investor or someone, and it just doesn't even sound real. No. Does time heal all wounds in a market like Hollywood? And
I believe it does. I mean, there's a lot of really bright spots on the scene. We've obviously got the Olympics coming. We've got the World Cup soccer. We've got those things. I mean, LA, they've been hurting after these fires. It's really tough what they went through, but we can sort of see the momentum building back. So it is time. And that's what we've been saying to our lenders, to Oaktree, to Marriott. It's just a question of time, and it will come back. I mean, LA is a spectacular place to live and to visit, and people will continue to go there.
How does politics come into play with your investing strategy, whether it's Europe or the US or specific states?
So it's interesting. So with our investing strategy, we're looking to avoid the extremes. And what I mean by that is it's almost come down to investing in red cities and blue states, and blue cities and red states, because that's where you don't have extremes in one way or the other. I look at San Diego as a red city and a blue state. I look at, obviously, I look at Greenwich, maybe a purple city in a blue state. I look at Miami as a blue city and a red state. So that's sort of where we focus. There's no sort of spikes in either direction, and they tend to also be the stronger destination markets where there's strong demand for travel and group and leisure and corporate and all of that as well.
So you bought the Hyatt in Greenwich, actually. It just kind of keyed me up on that. And that's a hotel I'm sure a lot of your competitors probably could have screwed up pretty easily. You took a different approach on the renovation. I think you added like a movie theater. What was your strategy there?
Well, when you look at Greenwich, you look at Fairfield County and you look at Westchester County, so many hotels have been taken out of supply. So in Greenwich, if you want to have a wedding or a bar mitzvah or a bat mitzvah, there's nowhere to go with the space, right?
Yeah.
And then I kept looking at this hotel, close to 400 rooms. We all did, close to 400 rooms, owned by Hyatt, and we negotiated with Hyatt to buy it from them. And they knew that we would do the right things by the asset, renovation, asset management, etc. But again, it's really taking a step back as a customer. What are we looking for? And so it's got an atrium. We cleaned it up. We created a great bar experience. We created, redid the meeting space. We redid all of banquet space, redid all of that. And then we took a step back. They had this, and it wasn't my vision, it was Greg's vision, where they had an auditorium style meeting room, but nobody's doing meetings like that anymore. And Greg said, Greenwich doesn't have a movie theater.
Oh, wow.
So we found a movie theater operator. We renovated it. It's like one of those truly bespoke theaters with the reclining chairs and the service and all of that. And it gets first run movies. And it's now busy all the time. And people are, wealthy residents of Greenwich will book the whole theater with their friends and family to watch a first run movie. It's just created an energy in that hotel. And again, nobody's building these things anymore in markets like, and Greenwich has changed so fundamentally since COVID, with people working from home more, and also a lot of, PE firms and hedge funds are up there. You used to be able to go to Greenwich any day of the week and find parking for lunch. You go there any day of the week now, you're not finding parking. I drive around all the time trying to find parking.
It's ripping.
It's just busy. There's great restaurants. There's a great energy, and the Hyatt is the beneficiary of that.
What's the kind of white space that you're thinking about that you're not totally doing yet that you'd like to be in the next couple of years?
I would love to be in sort of on scale, but again, I'm partial to Africa, right? But I look at some of these companies like Singita or And Beyond, or I forget what, maybe that was Conservation Corporation Africa, but where...
Yeah, I think that was And Beyond.
Yeah, and the Wilderness, where they're vertically integrated, especially like Wilderness, right? They're vertically integrated. They own the planes, they own the camps, they own the whole booking system, and all of that. I see, and it's not just Africa, but being able to get into a space like that, where it's all experiential driven at the higher end, where it's all bucket list items, that's going to continue to happen. And, you look at what's happening in some of like the Blackberry Farms, Blackberry Hills. I love that space. I'd love to get more into that, but on scale. But that's the dream. And then when I look at what KSL has done, they've done such an amazing job getting into hospitality adjacent businesses.
Yeah.
And, it was interesting. Somebody from FlexJet called me and said, oh, we just got a big investment from Louis Vuitton. And when you dig into it, it was Al Catterton and Dan Rohan's tactical ops team at KSL making a big preferred equity investment, which I think is phenomenal. I mean, FlexJet is a great company, and they made a very strategic investment. So they've done really well, getting into these hospitality adjacent businesses, and that gets me excited, as we try and emulate some of the things that KSL has done.
Do you think that includes real estate, or maybe not?
I think sometimes it would include real estate. I also look at senior living. Like, is that a space that we should be getting into? We were talking earlier about Tony Robbins and Fountain Life and the wellness and the diagnostic side. Is that a space? I mean, I'd love to be getting into all of these, but it's baby steps, right? I got to take care of what we're doing.
Someone told me a funny idea the other day, which actually I think could be pretty good. Like a gay senior living center.
Yeah.
Like gay hotels are really popular, but if you had like a gay senior living center, it could be wild, like a gay villages. Nice. You could be the king of gay villages.
Yeah. Look, I think there's so much white space out there. And that's what, when you take hospitality in general and you take those service standards, and as you said, it's a white space, it's just so much to be done.
The best part about being in the hotel business, I think, is like traveling to your friends' hotels or friends, hotels that you wish your friends owned, and, spending crazy rates. What hotels have inspired you recently, and what have you seen at some of those hotels that are just kind of amazing and blew you away?
We were talking about this right before the show, but and it pains me to say this because I want to keep it as a hidden gem. But my wife and I we were happy to go to Munich recently for my brother-in-law's 50th birthday.
I hope you were happy.
At Oktoberfest. We had a complete blast. But I said, why don't we go somewhere beforehand for 4 or 5 days to get wellnessed out before we go and drink a lot of beer? And so, like, it's interesting. I was having this discussion at the Independent Lodging conference last week.
Yeah.
Like, do you pick the destination, or are you looking for the experience and the destination comes afterwards?
Recently, I'm probably zeroing in on a hotel experience type of thing. And then the destination is kind of secondary. Like maybe it's like a type of destination, but it's very hotel driven these days.
So that's where we came from. Like we have Europe as our canvas.
Right.
We don't want the diagnostic spa wellness, which we would do at a different time, like
Right.
La Prairie or Lanzarote, one of those. We want a great bespoke spa experience in a unique place that we haven't been. And a friend of my wife, Kim's, recommended this place called Forestus in the Dolomites. And I'd never been to the Dolomites, but we flew into Munich. We went to South Tyrol. I didn't realize that all used to be part of Austria, and after World War One was handed over to Italy. The most spectacular landscape I've ever seen, just so different to anything I'd ever seen. But Forestus is 62 rooms and suites, and we had the half board, so breakfast and dinner. The most incredible rooms and views, service standards, food, spa, and then hiking. And it's just, I was just wowed every day. And, it's hard not to get a little bit jaded in this business. And I was just blown away. And I've been singing that hotel's praises to anybody who'll listen to me. And hopefully it doesn't double the prices and make it hard for us to get into next year. But we had an amazing time. But again, we chose the experience first and then looked for the destination afterwards.
So is that what you would say most people do, or most people are still choosing the destination first?
I think it depends. I think it's a little bit of both. Like you're going to France first and then trying to find an experience afterwards. Like with Kim and I, we were prepared to go anywhere in Europe, and we found Forestus. So I think people are experience driven. I mean, we all have friends who are going to Africa for the first time to be with the gorillas in Rwanda, and there's just so much of this multi-generational experiential travel going on.
I think there's definitely an opportunity for hotels to focus more on the well-being, the adventure, and the experience side. You have a lot of those remote hotels that have been very food driven. Maybe it's like a Relais and Chateau, and that's a huge pillar of theirs. But it almost seems like that same model, you got to keep the food to be amazing and 5-star, but to really increase all the activities. We went to a hotel called Ranch at Rock Creek this summer, and the food was okay, but the activities were, phenomenal.
Yeah.
And it's hard to find that in Europe, actually. You can find a lot of these like amazing hotels in Bordeaux, but if I want to bring my kids, I can't take them like on a wine tour.
Yeah.
So to add like, I don't know, pony rides or horses or a bike ride program is a real opportunity for a lot of those hotels, I think. And some of them are doing it, but others need to catch up.
Yeah. And look, at our lives change as those of us with children as they get older, right?
Yeah.
So I now have an 18-year-old and a 19-year-old. They're both athletes. They want to go places where they can be active with us. We like to be active as well. And it changes, right? So they're looking for new, unique experience, activity, hiking, biking, great gym. And so we're constantly like, because I mean, that's such valued time to be with them for 2 weeks in the summer or whenever it is. So we actually ended up joining exclusive resorts.
Oh, wow.
Because they have such an amazing offering of houses, right? And so now we can go with them and another family, or with them and their friends join us. And we've got Costa Rica lined up, and we've got Maya Cabal lined up, and we've, Sea Island, and, just doing different things. I don't play golf. I can't hit, catch, throw, or kick.
I don't either.
But they do. So it's time you spend together. It's why we do this every day.
Sea Island's amazing. We recently experienced that a couple of years ago. It's like you have these hidden gems in the US that you actually don't know about. They're not as obvious.
I've been aching to go there because we used to go to the Broadmoor a lot.
Yeah.
Phil Anschutz owns the Broadmoor and Sea Islands. So I did tell my boys that they have to wear a jacket at dinner every night. So there was some complaining about that. But I think it's a good discipline and decorum for them to have.
When you think about your life 3 years ahead, what would you like to be doing more of, and what would you like to be doing less of?
For me, I'm so blessed that I found my passion. I have no, it's all a blend. There's no work life. It's all one thing for me. I want to continue to be working with good people, I want to continue to be partnering with good people. I want to be there for my family all the time. And I just, they say you build your reputation drop by drop and you lose it by the bucket. And just making sure all the time that we're being good people. If they ask me, what do you look for when you're hiring somebody or interviewing them? I mean, it's almost like kindergarten antics. No biting, no scratching, don't exclude people, be nice to each other, no talking behind people's backs, all of that stuff. And so I just hope to continue to be able to do that with people who I love working with every day. I mean, I love working with everybody at Trinity on a daily basis. I feel truly blessed. I'm just so filled with gratitude for being able to do this and not it doesn't feel like work.
It's amazing. So we heard about Forestis. I always ask every guest on the podcast the same closing question. What's your favorite hotel? Give us another outside of your portfolio, amazing hotel that we can all go and check out.
So I might have said this on the on the last call, but I'm a creature of habit when we travel, and I've been fortunate enough to get a good corporate rate at this hotel, but I love staying at the Berkeley in London. It's just, the service standards are great. It's all about the service. It's like the show Cheers.
Yeah.
You want everyone to know your name. Now that's not going to happen, right? But you just feel comfortable, and the service standards are there. I love being there. Like the Beverly Hills Hotel in LA is just a very special place. The Plaza Athénée in Paris is just an incredibly special place. Las Ventanas in Cabo is like, wow, that's a truly special place. So there's a handful. I always love staying at the Mandarin in Hong Kong. It's just, you want these unique, bespoke experiences. And you're onto something when you're excited to go and stay there.
Is the common thread in all those places how they make you feel from a service standpoint? Is it the design, all the above? What do you think it is?
I think it's more service driven than the actual room product. It's, it starts with the doorman
and the hat.
And it just translates all the way through. And we all want that unique. You want to feel like you're in London, or you feel like you're in Hong Kong, or you feel like you're in Paris,
right,
or wherever you are. That is so important.
Yeah, that's key. I've seen some hotels recently that have a brand identity, and then they open up in a place, and I don't feel like I'm in that place. So then I'm like, do I want to stay there and try it out?
Yeah.
I'm sure it's amazing, but just the design doesn't feel like my vision of the place.
Like in New York, I've been staying at the Lowe's Regency on 61st and Park for 15 years.
That's your spot.
I left New York. And I'm unfaithful from time to time. I venture out and stay elsewhere, but I always go back because, I know the people at the front desk, and I know the people and the rooms are fine, and it's in a neighborhood that all my friends are happy to stop there on their way to or from work. And I feel like I'm in New York when I'm at the Lowe's Regency.
We always stay at the Bristol in Paris.
Yeah.
And last time my wife and I went to Paris a couple of weeks ago, we stayed at the new Hotel Cost.
Yeah.
Which was unreal. I think I heard the GM of the Bristol saying it was like the best room product in Paris. It was awesome, but totally different from the Bristol. Yeah. And we'll still always, go back to the Bristol, but maybe one time a year we'll stay at Cost because it's just this vibe, but the vibe's been burned into like the building for 25 years. Yeah. It's just, you couldn't open it and have it be that way.
The hotel I'm excited to check out, I haven't been in London since it opened, but it's the new Rosewood in the old American Embassy.
Oh, yeah.
Yeah.
And that's not in the War Building. That's in the Embassy, right?
No, that's the old U.S. Embassy. And
oh yeah, behind like Mayfair, like over there.
And so Michael Bonzer is the general manager there. I think he opened the first Rosewood in London. I've heard amazing things. I went through that the raffles at the old War Office Hour. Unbelievable. And they have this hidden bar that you need a card to get into. It's called Spy Bar.
Oh wow.
And I shouldn't be even talking about this, but Spy Bar is where MI5 and MI6 started. And so you've got Moneypenny's desk when you go in, and it's just really cool. But they have a residential side. We had a tour of the hotel. London's got some really exciting new luxury hotels right now.
It does. It's amazing. Thanks for going on the podcast. This is another
so much,
legend.
Jake. Thanks, Jake. Greatly appreciate it.
Hey, everyone. It's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter at Jake Wurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.